If you click on the Chapter 15 practice from Canvas, it will load that in Cengage. And these are just some examples that will be similar to your homework. In fact, some of them I literally pulled the non-algorithmic version of the homework question. And I thought we'd just kind of talk about Chapter 15 as we go through these examples. Okay. So a lot of Chapter 15 was just talking about costs and identifying costs and all of the really fun terminology, getting into product costs versus service costs and how we break down product costs. So this first one is just on classifying costs. But before I get into that, just to give you kind of a basic overview of the chapter when we're talking about, you know, why we do all of this, of course. So again, the whole purpose of managerial accounting is to focus on planning and budgeting and decision making. So you probably read or went through the little, when you were doing the adaptive study plan, like the management process. So let me just pull that up actually while we're in here. I think it's easier to have the visual on some of this. Find it. Okay, there it is. Once it loads. I think everything is running super slow on campus today after the power was out. So, of course, I'm getting like a blank exhibit 3. They're trying to kill me here. Like, show it. Anyway, we'll talk. Hopefully it'll load here in a second. But you know, the difference when you were studying financial accounting or studying it currently, we were dealing with statements to our external users, right? So the whole purpose of financial accounting is to produce income statement, balance sheet, retained earnings statement, showing our investors and our owners and everyone how we're doing financially. So when we switch over to the managerial side of things, we're still going to be producing reports and everything, but the big shift is that they don't have to be GAAP compliant. You know, they don't have to follow those generally accepted accounting principles because they're for internal use within the company. So we're really running them, you know, if we want to know production level of a certain product, we can run that report quickly and easily in our system, and then we can look at it and interpret it and use it however we want to. So it's not going to pull up because it's special. But it's basically showing, if you can pull up exhibit 3. Oh, wait. I said that and then it came up. Okay. So, you know, it's talking about basically, you know, we have these different management processes and they're all kind of work together. So when we're dealing with managerial, it is different because financial, you know, we would log all of our transactions, produce end of period reports, and then move on to the next period, right? So it was very, you know, cyclical and everything was the same. We've been steps the whole accounting cycle. So with managerial accounting, though, we really don't work in a linear fashion, as you can see, right, by this flow chart. So we start with planning. You know, it's always important to plan, like what are our goals? Where do we want to go, you know, next month, this year, 5 years from now? And then to do that, we make plans based on those goals. And then that all is kind of linked to a lot of other things, directing, which is the day-by-day management. You know, we put those plans in place. Those plans get set out to all the managers and people below them so they can execute those plans. And then we go into decision making. So then we have to make decisions based on where we want to go. And then once we make decisions, we go into approving and controlling. So we look at, well, what can we do better? How can we increase profit? How can we cut costs? And then we kind of go back. You know, all of it, as you can see, it all kind of goes together because we're constantly trying to improve and we're constantly making decisions. So it's different. Managerial accounting is just completely different than financial, and hopefully in a good way. See if I can get back. Okay. So that's kind of the overview. Just, you know, why do we use managerial accounting? Well, we use it to make day-by-day decisions. And then we do it to make decisions for the year, you know, and then also we do it to implement our strategic goals moving forward. So if our goal in 5 years is to grow our company by 50%, then we roll that back and say, what can we do over the next 5 years to get to that goal? And then we have to, you know, run reports and budget and plan and all of that fun stuff. So in managerial accounting, it's important to understand all the costs associated with running a business. And we're looking mainly in managerial accounting, we are going to focus on manufacturing. You know, in college accounting and financial, we did service and then we did merchandising. Well, now we're kind of switching gears more into manufacturing. So we're actually making goods in our warehouse or in our factory and then selling them. Okay? So we have lots of different costs associated with that. And that's why I gave you your nice little chapter notes. And you can use these, of course, on your homework, but also on your tests and things of that nature. So again, they're out on Canvas. And if you lose your copy, they're out on Canvas. I don't expect you to memorize everything in managerial because, as you'll find out, it's a lot of formulas and terminology. I want you to be able to take those formulas and apply them and be able to make decisions, basically. That's our end goal. So, you know, in this chapter, we talk about product costs a lot. So product costs really are made up of 3 costs, and we read those in the chapter. So you have direct labor, which is labor associated, obviously, directly with making the product. So those on the assembly line, right there making it. You have direct materials, the materials that can be traced directly to the product. And then you have all this factory overhead. Factory overhead is probably the more confusing one, but it's anything, anytime you see the word factory in the cost, like factory rent, or factory depreciation, or factory utilities, that's a pretty good clue that they're all overhead for the factory. And then also like the supervisor salaries for the factory would be considered a factory overhead, kind of like indirect labor. And then like indirect materials too. So if we use glue and we use it through a lot of the process, you know, it's hard to trace how much glue we use for every whatever we're making that uses glue. That was a really good example, wasn't it? So whatever we're gluing together. And then that's an indirect material, so it's an overhead cost. So this first one is really just going through and classifying, well, is it, you know, a direct materials, a direct labor, or a factory overhead? So what about if they said the plant manager salary? Oh, I guess we should read. This was for Procter & Gamble, a maker of consumer products. So what kind of cost is plant manager salary? Overhead, good. So plant manager salary is tied to the product, so it is a product cost, but it's an overhead cost because we can't really determine how much of their salary is put into each piece that we make, right? What about maintenance supplies? Overhead, right? What did you say? I heard overhead. Maintenance supplies are overhead as well. And again, you know, it takes maintenance to run the factory, so it's still a factory cost, but because we can't tie it directly to each product, you know, how much we're spending on each product. What about the salary of the process engineers? Overhead. Overhead. See, I'm just hearing what I want to hear, apparently. Yeah. I need an air kicked on and I can't hear it. I'm just like, yeah, overhead. That one is a little tricky because process engineers, they don't really clarify that too much, but I'm assuming they're the engineers, they're probably not working in the factory, so they're setting up the guidelines for how the factory works. So since they're not actually physically touching the product, they would be at factory overhead. So that one's a little tricky. Some of them, if we don't know what they're doing specifically, it gets a little bit tricky. What about wages paid to the packaging department employees? Direct labor, yeah. So they're actually physically dealing with the packaging of the product. So that's going to be a direct labor. What about scents and fragrances used in making soaps and detergents? Materials, yeah. So that one, again, I could see it both ways. They don't really But that one will be a direct materials cost. That one they do consider a direct materials. Probably because they have some measurement of how much they're putting into each product.
So why wouldn't the main supplies be direct material? I forgot what you said.
So maintenance supplies are probably, the person that's repairing the equipment. And so we can't tie that directly. We couldn't say, oh, well, say we make overhead projectors. We don't know how much of that maintenance supply cost is going into each projector we're making. So we just put it. So yeah, that's where materials we could say, okay, well, we use, 5 pounds of plastic for each overhead projector. And it takes 3 wires or whatever. So when we're talking about direct material costs, it's something that's measurable into each specific product.
Okay.
Does that make sense? Because it does get a little tricky, right? You're like, what is it, direct materials or indirect materials? So, yeah. So if we can trace the exact amount used in each product that we're producing, it's direct materials.
Okay.
If it's something that we just use and we can't say, oh, well, today we maintenance, and so all of these products got maintenance,
It makes sense.
Okay. It is a little tricky, though. What about wages of production line employees? Direct labor. Yeah. So they're working on the direct production. So that's direct labor. What about depreciation on the assembly line? Overhead. So depreciation will always be factory overhead if it's tied to the factory and it's an overhead factory. How about packaging materials?
Labor costs.
Do I say labor or it'll actually be materials. So it's direct materials. So it's not the people packaging it, but it's actually like the product. Resins for body wash products.
Materials.
Direct materials. And then depreciation on the manufacturing overhead. Yeah. So again, it gets a little tricky, but usually if it's any type of maintenance or janitorial or anything like that tied to the factory, it'll be overhead. As well as like utilities, if we had lights, gas, electric, all of that would be factory overhead. Any questions on that one?
Over packaging and sending it out.
Yes. Oh, well, packaging, though, I think they're talking about packaging it within, like its packaging, like in the bottle that so yeah, that's a good question. It is actually separate from the shipping department. Some put packaging and shipping together, but yeah, that's a good question. That's why these get a little
those
tricky.
Displays, like the little displays, I'm about to see at Walmart, that are made of cardboard that have things they're selling all over it. Those come completely in a box. So you just pull them out.
It's crazy everything that goes into all the costs are crazy. Okay, so we're still working on classifying costs. So in this one, we're dealing with manufacturing costs. Well, they use manufacturing and product costs interchangeably. So if you see manufacturing product costs, those are the same things. So the big takeaway is that your product costs, again, are direct materials, direct labor, and all of that factory overhead. Or sometimes they call it manufacturing overhead. I don't know why they can't just pick one term and use it throughout, but they don't, so we'll roll with it. So here we're looking at the following is a manufacturing cost report from Marching Ants Incorporated, and it wants us to evaluate and correct this report. So basically, we're seeing materials, and those materials used in production include some indirect materials. And then the direct labor includes some maintenance salaries, which wouldn't really be direct labor. And then they have a list of factory overhead. So basically what they want us to do is take these costs and fix them into the correct manufacturing costs. Okay? So, for example, on materials, when we're listing manufacturing costs, we want to separate out direct and indirect materials. Direct materials are classified as direct materials. Indirect materials should be under factory overhead. Same with labor. So direct labor would not include those maintenance salaries. Those maintenance salaries would be indirect labor under overhead.
So what would be like
An indirect material would be some kind of material that you would use that you wouldn't trace specifically to each product. So like glue or something like that that would be hard to trace a specific amount. Yeah, that's a good question. Sometimes those are harder to identify. So yeah, if they're really small, if it's a small thing and a small cost, we would usually call it indirect. So let's see. So basically, if you scroll down, the format they want it in is the same format. They just want us to correct it. So on a manufacturing cost sheet, we would always list direct materials, then direct labor, then our overhead. So we would start with cost of materials, cost of direct materials used in production. And well, they gave us the total materials used. So what's just the direct portion? Very good, 551,300. And we got that by taking the full 607,500 and pulling out that 56,200 or subtracting out the indirect. Okay. So our direct materials are actually should be 551,300. They had that wrong. And then how about direct labor? How much was the true direct labor? Yeah, very good. 478,100. So 478,100. So again, we're taking out those maintenance salaries that are indirect labor. Then after that, we just have to decide, are all of these factory overheads or some of them possibly not product costs? So that's a good time to kind of talk about, we've only talked about product costs. So we also have product costs versus period costs. You know? So product costs, again, are direct materials, direct labor, and factory overhead. So anything that can be tied to the product. Period costs are going to be like your shipping, your marketing, your administrative. So any costs like selling costs or administrative costs that go into the company. So like your CEO, CFO, all of their salaries will be period costs. Administrative workers like office managers will be period costs. Marketing, selling expenses are all period. And so then any expenses dealing with the office itself is considered a period cost. So when we first start going through the factory overhead, well, we know we had the maintenance salaries that were indirect labor. So they told us maintenance salaries were the 84,400. So my first factory overhead I'm going to list as maintenance salaries of 84,400. And then we also have indirect materials. Indirect materials were the 56,200. 56,200. So I know those two are factory overhead. So then I just go back through the other expenses. What about supervisor salaries at the plant or at the factory? Is that an overhead cost? Yes. Yeah. So those are tied to the factory, or they call it plant. So supervisor salaries will be an overhead, and it's 517,500. What about the heat, light, and power at the plant? Can that be tied to the product?
indirectly?
Yes, yeah, it's a factory overhead. Yeah, very good. So that is a factory overhead because it's tied to the factory itself. So basically all those factory overheads, what we do is we add them all up and then we calculate a cost per item. so that way we can include it into the product cost. Just so you kind of know where we're going with that. We have ways of doing that. So those utilities for the plant itself are a factory overhead, and that's $140,650. What about sales salaries? Would that be tied to a factory overhead cost?
No, not really.
Do it.
No, not really.
No, it wouldn't. It's actually going to be a period cost. So it does not go on our manufacturing cost. Okay, it's a period cost. Good. What about promotional expenses? No, that's a selling or marketing expense. So that's also considered a period. What about insurance and property taxes at the plant? Do it.
I don't think so.
You don't think so? I'll give you, anytime it says plant, it's going to be a factory overhead or factory. I don't know why they call it plants and then they call it factory. But yeah, if it says like it's tied to the factory, it will be a factory overhead. So insurance and property taxes for the plant or factory, 151,900. So those will be overhead. So we know we only have one more. What about insurance and property taxes at the corporate office? Can that be tied to the factory or to the product? No. So that's a period cost. Very good. What about depreciation on the plants and equipment? Yes. Yeah. So that's our last one there. Depreciation on the plant and equipment is a factory overhead cost. And then, of course, depreciation in the corporate office equipment is going to be considered a period cost. So basically, any cost within the manufacturing company can be broken into a product cost or a period cost. So period costs, again, are like selling, marketing, and administrative. Okay? But product costs are always going to be direct materials, direct labor, and then all that factory or manufacturing overhead. Any questions on those? Sometimes it's just like trying to remember, right? So gets a little confusing. So then we get total factory overhead. Did anyone happen to add that one up?
1,074,400.
Very good. So 1,074,400 in total factory overhead. And then we would just add up materials, labor, and overhead to get our total manufacturing costs. And what is that?
2,103,800.
Perfect. 2,103,800. So those are our total manufacturing or total product costs. Any questions on that one? Okay. Let's see, what do we have next? Okay, so now we're looking more at the financial statements. As you'll see with manufacturing firms, especially for managerial type income statements, they look different, right? You were used to seeing revenues minus expenses equal net income. You're still going to have your revenues and expenses. We just break them down differently, okay? So, and I think it shows that a little bit on the notes. I know my notes went a little bit. Shows the difference between merchandising and manufacturing. So that'll kind of show you, we had done the standard like from a service business where you had revenues minus expenses. And then in college accounting and financial, we did merchandising. There's too many M words there. And so your merchandising business, you would have sales, and then you take beginning inventory plus purchases to get inventory available. Subtract out ending inventory to get cost of goods sold. Sales minus cost of goods sold equal gross profit. As you can see, sales minus cost of goods sold are still going to equal your gross profit. You just get to cost of goods sold a little differently because we have now 3 inventory accounts. Okay, so before we just had inventory, right? Inventory is an asset, and we debited inventory every time we purchase goods. Well, now we're making goods. So we're going to have 3 different inventory accounts. So that's how things are going to change. This first one, though, when we're doing this first little income statement, it doesn't break it down as detailed, so we don't have to worry about the inventory accounts. But we will do one here in a minute that breaks down inventory. So they give us this information, you know, how many materials were purchased, how many were used, direct labor, overhead, goods transferred to finished goods, what we sold, how much we sold it for, or what our cost was and what we sold it for, and then our selling and administrative expenses. So again, with manufacturing, our income statement just looks a little different. So we're still going to start, though, with our revenues. Okay. So we're still going to start with revenues. And when I read through all of this, the only revenue I saw was on my app, right? We sold goods for $875,000. So that was our revenue for the month, was the $875,000. And then, thankfully, it tells us on G what the cost of those goods sold were. So we don't have to go in and calculate it all, which again we'll do in another exercise. But they actually give it to us. They said sold goods with a cost of $525. So they gave us the cost of goods sold. So in that case, on line 2, we're just going to subtract out our cost of goods sold. And I like to put it as a negative. It doesn't require you to, as you can see. But it is coming out. It is being subtracted. So revenues minus cost of goods sold. And that equals gross profit. So what's my gross profit? Very good, $350,000. So gross profit is what we made just off of the goods themselves. Okay, so those are your cost of goods sold or your product costs. So we'll learn how to compute cost of goods sold in a little bit, because that's when you have to, again, you know, out of all of your direct materials, labor, and overhead, and then figure out how much was actually sold. And then operating expenses, you're just going to break those down into selling expenses and administrative expenses, which they list up here. So as you can see, there's a lot of information we don't even really use when they gave it to us in this format, but we will down at the bottom a little bit. So we have selling of $125,000 and administrative of $80,000. So again, the selling and administrative, those operating expenses are your period expenses, or period costs. So we add those together, total operating expenses of $205,000. Again, you could put them in as a negative since it's cost coming out. So gross profit of $350 minus operating expenses of $205. We are left with a net income of what, $145,000? $145,000. So that's kind of a condensed income statement where we're not seeing the cost of goods sold computation. But if you scroll down, it's asking you to determine the inventory balances at the end of the first month of operations. So again, that's kind of what I was talking about, the difference from merchandising to manufacturing. In merchandising, we dealt with one inventory account, right? It was listed as an asset, we were good. Well, now we have 3 inventory accounts. So we have materials. So all of these inventory accounts are still assets. We just break them down into 3. So we have materials, which is our raw materials. So any materials we purchase, both direct and indirect, go into this account. And then we have work in process. Also in the inventory account, so it increases on the debit side. And then our last one is finished goods. So materials, work in process, and finished goods. So basically, they give us some stuff here. So in their little A through I, they give us what we've purchased, what we've used, and all of that. So again, anytime we make purchases, we purchase materials, that gets debited to this raw materials or materials account. So part A, we purchased 168,500. So that's purchases. That's all the materials we've purchased during March. And then they told us in part B, they told us in part B that we used 149,250 of direct materials. Okay. Well, when they tell us that we used direct materials, that means it came out in here. Okay. So when we use materials, we credit materials 149,250. I'm just going to put a DM for direct materials. Okay, so 149,250 gets credited to materials. Those materials go into the work in process. Your work in process inventory is where everything gets manufactured. So all of your product costs are going to go into this work in process. Okay, so those materials get transferred into work in process. Again, direct materials. So that was B. On part C, it told us we had 360,000 of direct labor. Again, all of those product costs go into work in process. So that direct labor, or DL, is going to go in. I lost my page. Where was it? 360 into work in process. Okay. So that cost gets debited to work in process for direct labor. It said we incurred 120,000 of factory overhead. That's a work in process as well. So factory overhead, or FO for short, we have 120,000 going in to factory overhead. So let's just kind of look there. Well, we can get our materials balance. We had 168,500. We used 149,250. So what's my new materials balance?
19,250.
19,250? Yeah. 19,250. And that's like the ending balance, right? So 168,500 minus 149,250. Materials has 19,250 left. That we can use next, April. Work in process, we probably want to add up these costs. So we'll get our total costs for March. So what are our total costs in March? Perfect. 629,250. So 629,250. So that's all of our product costs for March. That's how much went into process. Now, did we finish all of that? Probably not, right? We're always going to have ending balances. So it tells us on part E, it said we transferred 600,000 of this work in process to finished goods. So 600,000 was actually completed and transferred out. So we'll show that as a credit over here. The 600,000 goes into FG, or finished goods. That's also known as your cost of goods manufactured. So that goes into finished goods. That's how much was actually finished and ready to sell. And then, so then we could balance work in process. We had 629,250, 600 were transferred out. So what's its balance?
29,250.
Very good. 29,250 is left in work in process. Those are the costs still in work in process. And then last but not least, finished goods. Well, they told us on G that we sold goods that had a cost of $525,000. So when we sell goods, we're going to credit finished goods. That's cost of goods sold right here. If we had 600,000 and we sold 525, how much is still unsold in finished goods?
75,000.
Very good, 75,000. Okay. So I like to use T accounts. I think it makes it much more clear on the flow of costs. I use that a lot in managerial. Hopefully you'll find it useful. If you didn't use them in your other accounting classes, I know. Like, use the T accounts. So then we have our inventory balances, right? So materials was what, 19,250. Work in process was 29,250. And finished goods was 75,000. So that one really starts getting into the different inventory and how it's flowing through the process. So that's just how it's going to work. You know, really throughout the semester, you're going to see materials being purchased and showing that in the raw materials account. Work in process is going to see all of those product costs, materials, labor, and overhead. And then when it's finished, it's transferred out of work in process into finished goods. That's your cost of goods manufactured. And then in finished goods, whatever is sold, the cost of that cost of goods sold is credited to finished goods. So again, I just think the T accounts make it much easier to see that transfer. You don't have to use them, but it's helpful. So the next one's kind of easy. They give us a short one. Here we're just working on just a materials account. So again, though, I find the T accounts are useful because it tells us we have a beginning inventory in materials, we have an ending, and it shows us what we purchased. They want us to determine the cost of direct materials used in production, given that. So again, you could use the formula. You take beginning inventory plus purchases minus ending inventory, and that gives you, you know, the cost of direct materials used. But again, if you do it over here in a T account, you'll see the same thing. So for example, on that one, so we had a beginning inventory, November 1, of 64,900. So that gets debited. And then we have purchases of 490,900. 490,900. And then they tell us the ending balance. They give us this. They tell us we have 81,300 at the end. So what we're missing is right here. How much did we use? So again, what you do is you take your beginning inventory plus your purchases. Okay. So what's that?
See, 500,000 or 555,800.
Perfect. So all total, we had 555,800 goods available, or materials available, and we're left with 81,300. So to calculate what was used, we take the total materials minus that ending. Okay. So how much did I use?
$474,500.
Perfect. 474,500. So 55,800 minus the 81,300. So again, it's just a more visual representation. You're always going to take beginning inventory plus purchases minus ending inventory. 474,500. Okay, and you can balance, work in process, finished goods. If they give you a beginning and then the cost coming in and the ending, it's that same format, okay? But again, I like to show the T accounts. Any questions on that one? All right, that one's short, right? It's always nice. Have a little short one in the middle. Y'all having fun doing costs yet, It's like, woohoo! That time of day where everyone gets kind of like tired. So. All right. Let's see, we are on to number 5 here. So this one is showing information is available for Ch Manufacturing Company, and it gives us cost of direct materials used, direct labor, work in process inventory, and work in process ending inventory, and total factory overhead. So this one's fun. It wants us to do a statement of cost of goods manufactured, given this information. Well, again, on your notes, you'll actually see an example of a statement of cost of goods manufactured. So you can kind of follow that format. As you can see, what we do is what we did over here in this work in process. Okay? What we're trying to calculate on that statement of goods, of cost of goods manufactured, is find this right here. So if you look at your statement, you start with, if we had a beginning, we'd have a beginning balance, and then we would add in materials, labor, and overhead. So we would get the cost of materials used. And then, or total manufacturing cost, sorry. And then if we know our ending balance, we subtract to get cost of goods manufactured. So once again, when you're doing a statement or a schedule of cost of goods manufactured, what you're really doing is balancing your work in process account. Okay? So to me, I like to do that within my work in process account. You can do it on the statement too. We'll kind of do it both ways, because we're putting it in statement form. Okay. So they tell us we had a beginning work in process. So it was this July 1. Our beginning work in process was 316,400. Okay. And then we added in direct materials, and they gave us that 1,150,000. And then we add in direct labor, which is 966,000. And then we add in factory overhead, 490,500. Okay. And let's see, what did we have? They gave us our ending balance as of July 31st. This is supposed to be 355,500. So again, we're solving for cost of goods manufactured. Okay. Well, again, we can take our beginning balance plus materials plus labor plus factory overhead. It's a lot of pluses, right? So what do you get when you add up all of those? So beginning balance plus materials plus labor plus overhead.
$2,606,500.
Good. That would be just these three, right?
Yeah. So.
That's good. That we need that number. So our total materials, labor, and overhead, which would be our total manufacturing cost, is $606,500. So then our beginning balance. So our beginning balance plus that.
Yeah. 2,922,900.
Very good. 2,922,900. So those are our total manufacturing costs. Okay. So then we take this minus our balance. So the 2,922,900 minus our ending balance gives you what?
$2,567,400.
Perfect. 2,567,400. And that's our cost of goods manufactured. We'll say COGM for short, cost of goods manufactured. So again, that's it in the T account. That's actually the whole statement. So we just did all the calculations for all of this. Now we're just putting it in a different format, really. So again, what we always start with is work in process inventory July 1st. So that's that beginning work in process, which we listed up there, 316,400. 316,400. Our manufacturing costs are always direct materials, direct labor, and overhead. And these are all given. So cost of direct materials was $1,150,000. Direct labor was $966,000. And factory overhead was $490,500. So the manufacturing cost incurred in July is the $2,606,500. These three added up. So $2,606,500. To get total manufacturing costs, we add our beginning work in process plus those costs incurred in the month. So the total manufacturing costs in that work in process were $2,922,900. $2,922,900. And then we subtract out the ending inventory. So you have work in process as of July 31st minus $355,500. And we should get our cost of goods manufactured, which we already calculated, $2,567,400. So lots of calculating, right? But again, you can see it calculated here in the statement form, or you can see it all calculated in the work in process T account. So hopefully between the two, you'll find a way. You know, you might just prefer to work through the statement itself, and that's fine. Any questions on that one? Kind of one of the bigger chapter 15 statements that you do. All right. I believe we're on our last one. Yes, last one. Yay. As you can see, we're really working on another statement of cost of goods manufactured. The only difference is instead of giving us how many materials were used and all of that, they're giving it to us in a much more detailed format. So we have to find overhead. We have to calculate materials used. So they're really just expanding upon what we just did. So the main structure is the same. You know, we're basically balancing that work in process account. We just have a different format from inputs. Okay, so it's a little longer. Well, it's a lot longer, I guess, as you can see. They give us beginning and ending inventories for all three of our inventories: material, work in process, and finished goods. Then they give us materials and labor, well, in the other order, direct labor and materials. And then they list all of our overhead charges. So when we're doing a cost of goods manufactured statement in this format, as you can see, they're wanting everything listed out. We have to calculate materials used because they don't actually tell us how much materials were used, and we have to add up all the factory overhead. Bless you. So the good thing is we know the beginning one. Bless you. So we'll start with work in process inventory January 1 because that's up here. January 1 work in process 334,600. So 334,600. Okay. From there, again, I think it's easier to look at the T account flow so that way we can kind of see where all of this is coming from. So I'm actually going to make it like we need more room here. Okay. So the first thing we're going to calculate is how many materials were used. In the last example they gave us, the cost of used materials. Here we're going to calculate it. We did that in a previous example though. So what we're doing is we're taking our beginning inventory, so January 1 beginning inventory of 180,000. We're going to add in our purchases. Purchases were 1,375,000. Okay. So we add those two together. To save on time, I'll just give you these numbers. Should be 1,555,000. I like my other classroom better. I don't have to move back and forth as much. So when we're putting it in here, materials, we start with materials inventory, the 180,000. We add in our purchases, 1,375,000. That gives us the cost of materials available for use. Cost of materials available for use. So that's the 1,555,000. And then the next step is we're going to subtract out the ending inventory. So minus 145,500. The ending inventory balance is 145,500. So we subtract that out, and that gives us our cost of materials used in production, 1,409,500. So that's direct materials used. So that's our first step. We calculated the cost of direct materials used in production, and that should be 1,409,500. Okay. So now we have that. The second cost is material or labor. Well, they gave us direct labor. So on that next line, should say direct labor, and they gave us that 2,260,000. Okay, so direct labor was given. So when I start looking at my work in process, I'm going to do WIP for short here. Okay, just to kind of get us set up here. My work in process had a beginning balance of 334,600. Which we've already logged in. We added in materials, 1,409,500. Now we're adding in labor of 2,260,000. Okay. Now the next step is to add up all of those overheads. So it looks lengthy, but you're really just plugging them in, right? So it takes a little time. But you should have indirect labor, 115,000. Machinery depreciation is 90,000. Heat, light, and power is 55,000. Supplies are 18,500. 18,500. Property taxes are 10,000. 10,000. And miscellaneous costs are 33,100. So again, to save time, I added all those up. So our total overhead should be 321,600. 321,600. So factory overhead, 321,600. So then it wants us to calculate the total manufacturing costs incurred during January. Okay. That is going to be your cost of direct materials used in production, plus your direct labor, plus your overhead. So it just wants what we've incurred this month. So cost of direct materials, plus direct labor, plus overhead. And again, that would be, what, 3,991,100. So 3,991,100. And then we would add in the work in process, the 334,600, to get our total manufacturing costs, which should be 4,325,700. So 4,325,700. So basically, all of these costs are the 4,325,700. And they tell us our ending balance is 290,700. So to calculate our cost of goods manufactured, we'll take the total manufacturing costs minus ending inventory. So I'm going to subtract out work in process at the end, so minus 290,700. Cost of goods manufactured becomes 403,000, or I'm sorry, 4,035,000. Yeah, 4,035,000. The cost of goods manufactured. That comes from the work in process. So the last thing they want us to do is determine the cost of goods sold. Well, what I'm going to do there is set up my finished goods account and balance it. Okay. So my finished goods, trying to think of where y'all can see this. I'll put it here. Step G for finished goods. It gave me the beginning balance of 675,000. Okay. Work in process is cost of goods manufactured, gets debited to finished goods. So that 4,035,000 flows into finished goods. Okay. And then it tells me my ending balance. My ending balance is 715,000. So I would take my beginning balance plus the cost of goods manufactured minus the ending balance. Okay. So cost of goods sold will be the beginning balance plus the cost of goods manufactured minus your ending balance. And these are all of finished goods. So the beginning balance of 675,000 plus 4,035,000 minus 715,000. you should get 3,995,000. That's our cost of goods sold. And that formula is on your notes. Oops, throwing things. So on your notes, you will see just the formula. Cost of goods sold equals beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory. Again, really what you're doing is balancing that finished goods account. Okay. So cost of goods sold is 3,995,000.
So they only made 40 grand on
Oh no, that's all costs. So that isn't how much we sold it for. And this is the cost of all the goods manufactured in the period, and this is what was sold. So we would still have like, you know, that's still costs that will move into the next period. Yeah, that's a good question. So yeah, that's just the cost of goods sold. So then we would take whatever our revenue was minus cost of goods sold to calculate that gross profit. Okay, so I know that's a lot of information, right? We have 5 minutes, no, 7 minutes. You have more time than I thought. Do you have any questions so far?
I think for me, it's just putting it in order, like
Yes.
material inventory. Remember that order.
Yeah, it's tricky at first. It's a lot of new material. So again, I hope the T accounts kind of help like visualize it as you walk through it and the notes. But these are kind of similar to a lot of the homework problems you'll be doing too. So you can get back into this and kind of go over it. And then again, if you guys have any questions, you know, come by my office or email me, and I'm happy to help. So be working on the chapter 15 homework. It won't be due yet, but if you start working on it, and then Wednesday when we start class, I'll open it up to any homework questions first. So if y'all are working on it, you run into anything, we need to pop one up and do it together, that's fine. So be working on 15 homework and do the next chapter, chapter 16, the adaptive learning plan. I only see you guys once a week, so it goes fast, doesn't it? So, but yeah, email me or come by if you have any questions. Otherwise, have a great week and have a good Labor Day weekend, right? So have a long weekend.